We're going to chat about the first in a series of Forex myths, and today's session is brought to you by DisciplineForexTrading.com, DisciplineForexTrading.com. And what we're going to do is continue on a trade that we had started on the 2nd of July, videotaping the trade on the 2nd of July, and it's on YouTube under Forex Simple Systems. We continue here going long. We're actually stopping our short trade, reversing, going long right there. And we'll get to the point where we are today. And that's right there. So the long's looking okay. No gigantic, great anything one way or the other, but definitely step in the right direction. Now, one of the things that I wanted to talk about here and to dispel, again, one of the things that is available for you to learn inside of the Discipline Forex Trading course is the indicator myth. A lot of times you'll see, people talking about indicators, and they talk about price action as if price action is something that is newly discovered, like something that was discovered in the 2000s or something, like it's such a big deal. But price action goes all the way back to trading the tape before there were ever any charts available. So price action is nothing new. It's just something that's hyped up to make you believe it's new, so that someone can make their product seem much more appealing and cutting edge than it actually is. Actually, in reality, price action is older than indicators. So price action, when there was, again, no charts, no computers, no anything, stock traders read the tape and they went with price action and other things to, order flow, etc., noise on the floor, lots of different things that being on the floor, information that they got from being on the floor of the exchange at the time. Now, here we go, and again, we're going to take a quick look here. This is a very simple system, nothing complex here, nothing fancy. It's using an indicator, the simplest indicator there is, a simple moving average. Okay, and as people are running around grabbing 10 pips here, 10 pips there, nothing wrong with that. Scalping, day trading, all of these are legitimate as long as someone has a trading plan and a system that they can use that actually works. So, if you're looking at those types of things and people who are ignoring the power of just using simple indicators, which you shouldn't really ignore, then they would miss out on things like 500, 1,000, 1,500, 2,000, 2,500, 3,000. We're talking about thousands of pips, not just tens or hundreds. And that's the power of this particular type of trading. Now, here's another thing that'll be interesting to people who are talking about indicators in a negative light, is the lagging nature of indicators. And of course, this is nothing super secret or new. The truth of the matter is the lagging really detrimental? Well, it depends what you call detrimental. If you're looking at the $20,000 per full-size contract here that was done with very simple trades, then no, the lagging is not important. But I think the point that people try to make is that perhaps we could have gotten out at a better place. So they look at this and they think, wow, we left all this money, all these pips on the table by not getting out at the very bottom. Well, in reality, no one can pick a top or bottom. And anyone who says they can, I'd ask to see their account statements if I were you. So the lagging nature of the particular moving average used here, and just a single moving average, okay, so we got out and we left money on the table. Don't focus on how much money you're leaving on the table. Focus on how much money that you're taking with you and the equity that you're building. Focusing on what's left on the table, going back and going, I coulda, shoulda, woulda, can end up being a losing game. Now, I'm not saying don't use that in order to hone your skills and time your entries and exits more. There's absolutely nothing wrong with that. But something as simple as this type of trading shows you that super high levels of precision are absolutely not necessary in order to make a profit. Absolutely not. So don't worry about what you're leaving on the table. Go for the lion's share. And in that particular case, maybe you'll start to look at integrating the types of systems that, like this one, that grab thousands of pips, and integrating that into whatever you do as far as short term, your scalping or whatever. So the Forex trading myth of the day is that indicators are bad. And to reiterate, the indicators are bad because they're lagging. This is what people will tell you, etc., etc. An indicator is simply a tool, okay? And it allows you to visualize trends or lack of trends or whatever. And a tool is only as useful as the knowledge of its correct usage is. So if you're trying to eat tomato soup with a fork, now a fork is a great tool, you'll find thin tomato soup, and trying to eat it with a fork is very difficult. Well, so you'll say, wow, would you say forks are bad? Well, of course not. Number one, you're using the wrong tool for the job. Okay, so you use the wrong tool for the job, you get poor results in trading and in life. So, again, that's the wrap up on the Forex myth number one, that technical indicators are bad. Thank you, and be sure to visit our sponsors, disciplineforextrading.com, and grab your free Forex trading guide.